Aloha, this is Kurt Nielsen with eMortgage Hawaii, and this is your mortgage market update for the Hawaiian Islands for September 13th, 2013. Today I'm going to talk about two very important things that are happening in our industry. First, I'm going to talk about what's happening next week with the Federal Reserve. They're meeting on September 18th, and the main subject, and we've been waiting for this for 5-6 months now, is how they're going to start tapering the purchase of mortgage-backed securities. This has been an effort by the Federal Reserve to keep mortgage rates as low as possible to stimulate the housing industry. Now they're talking about stepping out of that effort and letting mortgage rates rise to the normal mortgage rate that would be set by the market. So that's extremely important and really is going to set the trend for mortgage rates for the next 12 months. Secondly, over the next 7 to 8 weeks, we're going to see the new qualified mortgage rules be implemented by all of our lenders. Fannie Mae and Freddie Mac will implement their new system on November 16th, and between now and then the lenders will set the guidelines in place for 2014. So you really need to know how that's going to affect your client and what it means to them. So let's move on to where current rates are right now. The 30-year fix is at 4.5%. with just a small fee with most lenders, and the 15-year fixed is at 3.5%. Now this is up on the 30-year fixed from a low in January of 3.0%. So rates have actually gone up 50% since their historic low in January at 3.0%. But let's put this in perspective. At 4.5%, we're still well below where mortgage rates really should be if the federal government wasn't manipulating them. And historically, it's still an exceptionally low amount. So, given that, I think it's an important message to your clients that the rates are still a bargain, and they're going to go up, especially since the Fed is going to step out of the market, and they're going to let mortgage rates rise to where they really should be, where the market would set them without government intervention. I also want to look at jumbo rates. I mean, if you look at how they compare to conforming rates, typically they were at least a half a point higher than conforming loan rates. But right now, they're just as good or even better in some instances than conforming rates. Now, the reason for that may be that the banks have lost a lot of business because refinances have gone away, and they're really looking into bringing in business. Their cost of capital is still very low, and so they're holding jumbo rates very low in order to attract business. So that's a bright spot in the market, something to share with your clients that are buying higher end properties, that now's the time to jump in and lock in a jumbo rate before these rates go away. So good news in that arena for sure. Now let's talk about the mortgage-backed securities market, and I want to show you where the trends have been. Now remember, when we're dealing with the bond market, what we want to see is prices to go up. That means rates go down. It's an inverse relationship. But over the last 4 or 5 months, we've been seeing the opposite. We've been seeing the price of mortgage-backed securities drop. That means interest rates are going up. And that's really been going on since the beginning of May. So we've had a long stretch of rising mortgage rates since the beginning of May, and that was really when the talk about the federal government tapering their purchases of mortgage-backed securities began. It was at the Fed meeting in May when that was discussed, and ever since then we've been seeing mortgage rates rise. So I don't expect this trend to end, but we're going to talk a little bit more about the repercussions of the Federal Reserve's meeting next week and what could happen. So we are now at a 2-year high for mortgage rates. Again, I expect this to generally continue for the next 12 months with, you might have some peaks and valleys, but it is certainly going to continue. And I think by the end of 2014, we'll probably see mortgage rates back up around 6%, maybe even above 6%. So it's still a very good time for clients to buy and lock in those mortgage rates as long as they're below 5%. Okay, let's talk about the meeting next week. It's on Wednesday, September 18th. And basically what this is about is the federal government has been implementing what they called QE3, Quantitative Easing 3. This is the third round of the government intervening in the Treasury and the mortgage-backed securities market to keep interest rates extremely low. And the thought there is to stimulate the housing market, which they have been doing. It's actually worked. Basically, the Fed has been purchasing $85 billion a month of mortgage-backed securities. That's more than is originated in the United States on a monthly basis. So not only are they buying all the mortgages, they're buying other people's portfolios, like pension funds and such, who hold mortgage-backed securities in their portfolio. So that's going to theoretically go away over the next 12 months. Now the question is, how quickly are they going to taper their purchases and get out of the market? Even when they get out of the market, they have stopped purchasing mortgage-backed securities. The next question is, what are they going to do with all the mortgage-backed securities that they purchased? They're going to have to sell those. So that's the next step, but we're not going to talk about that for at least a year. But again, the Fed has got trillions of dollars of mortgage-backed securities on their balance sheet that they eventually are going to have to sell off. The decision we expect next week is how quickly they are going to back out of the mortgage-backed securities market. It will set the trend for the next year for mortgage rates. Now, I see that there's going to be three potential outcomes from the meeting next week. One is they could delay the tapering. That would be great for rates. That would signal that the Feds don't have confidence in the economy. So sometimes bad news would be good for rates. I don't give this any chance. I definitely think the Feds are going to talk about their tapering. The second outcome would be that the Fed announces they're going to taper equally both treasuries and mortgage-backed securities. This would be, bad for mortgage rates. I think a lot of that's built into the market already, so I don't expect any kind of jump in mortgage rates unless something really strange comes out in the meeting, because the market's already kind of built this in. Now, there's a third option, and one that I listen to Barry Habib every day. He's in the mortgage industry and has a great insight into where rates are going in mortgage-backed securities. And there is a possibility that the federal government will come out and say, okay, we're going to taper, but we're going to focus more on treasuries than mortgage-backed securities, and we're going to continue to buy mortgage-backed securities at a disproportionate level to treasuries. If they came out with something like that, that would be good for interest rates, at least in the short term, for mortgage rates. So again, next week it's going to be important. Please look for my video next Friday. We'll be discussing the end result of this meeting. So again, this meeting will set the tone for interest rates for the next 12 months to come. Okay, the last thing I want to talk about are the new guidelines for mortgages that are coming out from the CFPB. And Fannie Mae has announced that their new system will be online by November 16th, so I expect all lenders will probably implement these rules between now and then. And in fact, we're already getting our lenders announcing the implementation of certain aspects of the new qualified mortgage rules. Now, basically, qualified mortgages provide lenders safe harbor from litigation if they follow the rules. So if they can prove that when they gave somebody a loan, they followed all of the rules of the qualified mortgage, then they are protected by law from litigation from the borrower as long as they didn't do other things. So it's an advantage for a lender to follow these rules. This was part of the Frank Dodd Act, and it was initiated by the CFPB. Again, the CFPB is the Consumer Financial Protection Bureau that really does oversee all financial institutions. I believe this really is the last round of major guideline changes to the mortgage industry, and hopefully from here we won't see so many changes on a month-to-month basis. So I think this is really the last round of changes. Now the first thing that's going to be eliminated, and we already have lenders that have already announced they've eliminated the no non-amortizing or no interest or interest-only loans. So basically they're getting rid of interest-only loans. So your clients are going to have to pay principal and interest on all the loans that get originated once these rules are put into place. There are no longer any loans that have terms in excess of 30 years. There used to be a 40-year amortized loan. It's kind of in between an interest-only loan and a 30-year fixed. So those are gone too. There's also going to be a 3% fee limit on all loans that originated as a qualified mortgage. Now, they haven't really finalized what fees are going to be included in this number. We're looking at the loan officer's origination fee, we're looking at the underwriting fee, and it also includes any fees that an affiliate of the lender charges. So let's say the lender owned a title company or an insurance company. Those fees would have to be included. So what's going to happen, I believe, is all those affiliated relationships are going to end for most lenders because they won't be able to stay under this 3% fee limit. The question is, will third-party escrow and title fees be included? We haven't heard the final on this. I don't think they're going to be included. But the issue with this fee limit is when you get into the lower or the smaller loan amounts, you really are going to have a difficult time making any profit if they set a 3% fee limit. So, for example, if somebody wants a $50,000 loan or a $75,000 loan, a $50,000 loan, you can only charge $1,500 in total fees. Well, if the underwriting fee is already $1,000 or $900, that doesn't leave much margin for anybody to make a profit. So I would think that the smaller loans, lenders are going to not be incented to offer loans to those clients. So I think this is a misguided guideline that they're including in the qualified mortgage rules. The next one is a big one. They have dropped the total debt to income that's allowed from 45% to 43%. This is a 4% drop in your client's buying power. Now, this has already been implemented by many lenders. In the next 8 weeks, I think it will be implemented by everybody. So in essence, they're saying we're not going to let your client lever up too high based upon their income. The key to the qualified mortgage rules are that the lender has to prove that they analyzed and showed that the buyer has an ability to pay up to these debt-to-income ratios. So we have to be very, very thorough in analyzing the buyer's income, and it has to be income that is expected to continue without interruption for at least 3 years. So that would be somebody's salary, a wage. Does not include things like capital gains that you can't prove will happen every year. There are some capital gains that we can use. That would be, let's say you sold a business and you're going to get money every single year for the next 15, 20 years. That we could include, but it has to be expected to continue uninterrupted for at least 3 years. So that's really the key behind qualified mortgages. We spend a lot of time improving the income, the assets, and employment. And employment is a big issue. There are a lot of people that switch jobs, and if they switch jobs and change their line of work or their career, they may not be lendable for the next 2 years. So employment is a very big issue, especially with self-employed borrowers. There's no way that we can qualify a self-employed borrower without tax returns. So if you have a pre-qualification letter from somebody, one of your clients, make sure that if they are self-employed that they have, the lender has reviewed their tax returns. And there's so many times that I hear from realtors, oh, my client's very wealthy, they'll qualify easy, they're putting 50% down. I don't care if they're putting 99% down. If they can't qualify for the 1% of that loan with their income, they are not going to get a loan. So if they're retired and they have no visible source of income, they are not going to qualify for the loan. It doesn't matter if they have millions of dollars in the bank. So really important that you know your client and ask those questions. Okay. Another thing that's happening, this is not part of qualified mortgage rules, but Fannie Mae and Freddie Mac have announced that they are going to reduce conforming loan limits in 2014. They have not announced what that's going to be, but this is the first reduction in loan limits since 1990. What I believe is going to happen, and we'll know in the next few weeks, is that they're going to eliminate the high balance conforming loans. So in some places you can get a loan as high as $729,000. Those are going to go away and will drop back down to $625,500 for all loans across the state of Hawaii. I don't see that as a big deal because the rate on those high balance loans really wasn't even competitive with jumbo lending. So I'm not concerned about it. I don't think you should be concerned about it, but maybe if you want to talk about it further, call me and we can go through what the other options are for your clients. Okay, the last thing I want to talk about is qualified residential mortgages. So we have two different guidelines. Qualified mortgages are about the borrower, making sure they have the ability to pay. These guidelines are about the loan, making sure that it can be sold in the secondary market. Now this was designed or endorsed by the following agencies: the FDIC, the Federal Reserve, the Office of the Comptroller of the Currency, the Federal Housing Finance Agency, the SEC, and HUD. And basically it's another set of rules that apply to loans being sold into the secondary market. This is typically jumbo loans, non-conforming loans that we're focused on here. Now, initially they talked about requiring the client to put at least 20 to 30% down for a QRM. That has since been rejected. That would have been, I think, pretty stiff and would have eliminated a lot of borrowers. But again, it's a different set of guidelines for loans sold into the secondary market. So the real question is, now we got two sets of rules. We have the qualified mortgage rules that get applied to Fannie Mae and Freddie Mac loans, and we have the QRM loans for loans that are sold into the secondary market. So the question is, which are going to prevail? It would be wonderful if they just align themselves and they agree to be the same, but so far we don't see any indication of that. So my guess is, if I were a bank, I would probably look at both sets of guidelines and select the most conservative guidelines from each set of rules. And my guess is that's what's going to happen. But this is kind of, you can see what we have to deal with in the brokerage world and lending world, is you got all these guidelines out there. Which ones do you follow? So we'll have more of this throughout the end of the year of how this settles out. I do hope that the QRM guidelines follow the qualified mortgage guidelines. Okay. One last thing I want to talk about is really knowing your client. I touched on this when it gets back to qualified mortgages. Remember that if you're dealing with self-employed people, you cannot qualify them unless they have 2 years of tax returns in the same line of employment, and we have to be able to analyze those tax returns. Have they recently changed jobs? They may not be lendable if they've changed jobs. Again, I talked about this earlier. My client is very wealthy. Assets don't qualify buyers. The income does. So if they have lots of money but no income, they're probably not going to be qualified for a loan. This gets back to the buyer's ability to pay. We have to prove that, or it's not a QM loan. Also, ask a little bit about a history. Now, I know this is kind of private and confidential information, but if your client has had a foreclosure, a bankruptcy, a short sale in the last 7 years, or they've been divorced, there's a lot of issues that these are issues that we need to know up front, because they may not be lendable. And there's a lot of disinformation out in the marketplace about when you become lendable again after a foreclosure or a bankruptcy or a short sale. And each lender has different guidelines and overlays, so not every lender is going to apply the rules the same. Okay. my advice is make sure that your client is pre-qualified by somebody you trust. Somebody that knows Hawaii, that knows the client, and knows all these rules. If you get somebody that's green in the business and they issue a pre-qual letter, you know, there may be problems with that client that they're not looking into. So really, you've got to get set up a relationship with a loan officer that you know will do the due diligence before issuing a pre-qualification letter. And finally, just know your property. There's a lot of issues here in Hawaii that we have to deal with. For example, CPR properties, even though it's a single-family residence, if it's on a CPR lot, it's treated as a condo. We need condo docs if they have condo docs. Is that property off the grid? If it's off the grid, we probably can't lend on it unless we can show, and the appraiser says, that this is common for the area, it does not affect the marketability of the home, and they have to have at least 3 comparables of homes that have sold recently that were also off-grid. So generally, you're probably not going to get that. Does the property have a shared water meter? If so, you need a shared water meter agreement. We've had this come up at the end of the loan, a week before we're trying to close, and we find out from the appraiser that there's a shared water meter. We can deal with it, but we'd rather deal with it up front. It doesn't take much to get a shared water meter agreement if one doesn't exist. Also, shared access roads. We need a road maintenance agreement between the owners if it's shared access. So again, if we have this up front, it's not a problem, but if we find out after the appraisal is done, then we're scrambling at the end of the loan. Does the property have a shared cesspool or septic? That's simply not allowed. That's a violation of the EPA, and you cannot get a loan on any property with shared septic or cesspool. Finally, are there unpermitted structures and additions? We can get loans completed if there are unpermitted additions or structures, but we have to know about it up front, because if we submit to the wrong lender, some lenders don't allow anything unpermitted. So again, it's important to know this stuff up front. If you don't know, pull the permits from the county planning department, make sure they've been closed out, and make sure everything on the property that you see was covered by one of the permits. Okay, and finally, I do have an improved mortgage calculator for your smartphone. It calculates mortgage payments for conventional, FHA, VA, USDA right there on your phone. Each of these have different mortgage insurance cost attached to them, so it'll calculate that for you. It'll show you the current rates and give you update on mortgage news right there. It's kind of a news ticker right there on your smartphone. It also has some training videos for your clients, what to expect during the loan process, and other information about the mortgage market. So to install this, open the browser on your phone, enter the following address into the address window. Then tap your forward button, add it to your home screen, press add in the upper right hand corner, and then enter your name, email address, and cell phone. It's a great little free mortgage calculator, and I think you're going to find it very useful for you and your clients. If you have any questions, give me a call. I'm at 808-334-6201, 808-334-6201, and we'll talk to you next week. Look for my video at the end of next week, because it's going to have the results of this Federal Reserve meeting, which I think is going to be very important for mortgage rates as we go into the next year. Thank you very much.